Hi everyone, welcome back. In this video, we are going to understand T account and the ledger. These are very important in accounting because they help us organize financial information clearly. First, let's look at why do we organize accounts. When a business makes transactions every day, those transactions are first recorded in the journal. The journal records everything in time, meaning it shows what happened first, second, and third. But if we only use the journal, it becomes hard to know the balance of one specific account, like cash and rent expense. That's why we use the ledger. The ledger groups transactions by account. This makes it much easier to see how much money is in each account. Now, what is T account? A T account is a simple visual tool used in accounting. It looks like the letter T. The left side is called debit and the right side is called credit. A T account helps us track increases and decreases in each account clearly. One important rule to remember is very simple. Debit is always on the left and the credit is always on the right. Only the amounts changed, but the sides never change. Next, let's talk about the general ledger. The general ledger is the formal record of all the accounts used in a business. Every transaction that is first written in the journal is later transferred or posted into the ledger. This process usually follows 4 steps. First, the business transaction happens. Second, the transaction is recorded in the ledger. Third, the journal entry is posted to the ledger accounts. And fourth, we calculate the balance of each account. Now, let's quickly look at the main account types. Assets. Assets are the things the business owns, like cash, equipment, inventory, and accounts receivable. Liabilities are amount the business owes, like bank loans, salary payable, or rent payable. Equity represents the owner's investment in the business. Revenue is the income the business earns from sales or services. Expenses are the cost of running the businesses, such as rent expense, salary expense, or electricity expense. Another useful thing to remember is the normal balance. Assets and expenses normally have a debit balance, and liabilities, equity, and revenue normally have a credit balance. Now, how do we find the balance of a T account? First, add all the debit amounts. Then add all the credit amounts. Next, subtract the smaller total from the larger total. Remaining balance stays on the larger side. That is how accountants know the final balance of each account. Here is a simple real-life example. A business starts with $1,000 cash. Then it earns $500 from sales, so cash increases. Later it pays $300 for rent, so cash decreases. After comparing both sides, the final cash balance is $1,200 on the debit side. Before we finish, here's one important comparison. The journal. The journal records transactions in time order. The ledger groups transactions by account. That is the key difference between journal and the ledger. Let's do a quick recap. A journal records transactions in time order. A ledger groups transactions by account. A T account has debit on the left and credit on right. Every journal entry is posted to ledger. To find the balance, compare total debit and total credits, and the balance stays on the larger side. Thanks for watching my video. If this video helped you understand T accounts and the ledger, don't forget to like, subscribe, and see you in the next video. Thank you.